Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Hello, everybody. Welcome to another episode of the Jones Zone. Today, we've got Joe Omahan from Cornerstone First Bank. They're a mortgage bank, which is different from a mortgage broker. He'll explain that. In fact, Joe, why don't you delve into what is the difference between that right now?
We're an independent mortgage banker, means we're a delegated banker where we have up to 40, 50 different delegated investors that we're approved with. We have the underwriting pen. We underwrite the files. We fund the files. We sell them way after the transaction. So we're actually the independent bank that's making the decisions, whether it's Fannie Mae, Freddie Mac, government loans, non-QM loans, seconds. We have everything here. So some of the things, the benefits of an independent mortgage banker like ourselves, when we pre-approve a loan, we're pre-approved with the bank. We're not making a qualification for the borrower, like a budgetary item, where a broker might be taking the numbers and then they're relying again on another bank.
You know what? Let's talk about pre-approval and pre-qualification. That's something that everybody gets asked, all the buyers out there. What's the difference between pre-approval and pre-qualification?
That's a great question. This comes up a lot. Many times a borrower meets a loan officer, whether the loan officer is a broker or a banker. That person puts together, and a pre-qualification would almost be like a budgetary item. That loan officer would then look at the numbers. They would give them a budgetary item and progress, tell them what they think they qualify for, what their budgetary qualifies for.
Just based on a phone call. So the big difference is that's just based on kind of a phone call.
Phone call, I make $62,000 a year.
How much you make?
How much you make?
Owe.
What your perceived credit score would be. Do you have good credit? How much do you owe? Those are the basic questions you're going to ask. And then you could do a mathematical formula and say, oh, well, here's your ratios. They use the word debt to income ratio. And they say you would qualify for $550,000.
And that's a pre-qual over the phone compared to a pre-approval is when you go to the next step of verifying all that information.
Yes. Now, in a pre-approval status, the borrower's going to put in a full application. We're going to authorize, run their full credit. We're going to get 2 years income history and verification. We're going to get their asset verification. And actually, the bank is going to go ahead and now pre-approve a borrower based on an interest rate and a loan amount up to what they truly can fund their loan at. So they're approved when they're going out. They're not qualifying based on estimated numbers, which you would then have to document later.
So obviously a pre-approval is far better. Now tell me about, you mentioned credit. How big a deal is credit? What does that affect? Not only them being able to get the loan, but I'm guessing interest rate too. Tell us a little bit more how credit has an effect on people's mortgage. Obviously, some people with really horrible credit can possibly not even get a loan, but if they have really stellar credit, what does that mean to the borrower? Tell us how important credit is to them.
It's very important for the borrower. Yes, people consider their debt in qualifying a debt to income ratio, but the quality when they get a credit score is really important. Their pricing model is going to be based on the higher the credit score, the borrower is going to get a better price.
Price meaning interest rate.
Interest rate, they're going to get a lower interest rate and less cost for the better credit they have. They're going to qualify for less programs for having a lower credit score. Government loans or pseudo-government loans like FHA-backed and VA-backed, they'll do loans down to an aggressive 500 credit score. They make them bring in 20%, a little bit more stringent lending. They still will lending, but typically when you come against, people know Fannie Mae, they want a 620 score, but your pricing is going to be much higher on the interest rate than such having like a 760 score.
Is that the cutoff? 760 is kind of
Once you get that 760 rate, you're going to get the premier rate and the lowest possible rate. I know some people say, well, I'm an 840, 760 almost across the board on all lending facts is about where you're going to get the most benefit and the lowest rate.
Is 840 the highest credit rating you can get?
Oh my gosh, I've seen 840, 845. Somebody's going to come in, call me and say, hey, I saw 850, but it's about there. But once you get over 760, there's almost no difference in price, if there's a difference at all.
You threw out the words debt to income ratio. Now, you talk to us like I'm a fourth grader. What is a debt to income ratio? What does that mean?
So the debt to income ratio says the borrower is going to have a gross income of monthly of $10,000. They're going to look at what my principal and interest with my tax insurance payment, their housing payment, Let's say that total is $5,000. Well, now they have a 50% debt to income ratio. They've about maxed out or gone over all the criteria. But also now let's say it was $3,000. They have a 30% front end or housing ratio. Then you add all their monthly debts like cars, leases, student loans, and you would look at things like credit card debt. So obviously one of the worst things you can do, and I know people are excited, they could go out and start maxing out their credit cards, buying furniture, buying that new home, all those things possibly should be weighted down the road to keep that debt to income ratio under the level so they can qualify. And it could even affect your interest rate as it gets over possibly 45 and numbers like that. Your interest rate could go a little bit higher.
I think I remember years and years ago that someone was really excited. We're in the middle of escrow, and it was all good, fine and dandy, and they went out and bought a car. I'm not sure if they couldn't get the loan, if they had to change the loan or what they had to do, but I remember it being a big, big deal. So anybody looking to buy a house, don't make any big purchases, especially during escrow, especially after they get pre-approved, because that'll change the number. So it sounds to me like when you have a better credit score, you have so many more options, giving you potentially a much better rate and even less fees.
Less fees and potentially much less down payment. So you might even get to go for a higher loan to value, meaning I get to put less down, I get a lower interest rate, and it's going to be much benefit. But I have seen, I think a great job by a loan officer or the lending institution is early in the process as they're applying, as they're getting pre-approved, to maybe reiterate that, because buying a house is emotional. It's the greatest and probably the largest expense you make. You're excited. Maybe you have kids. You want to pull that
Yeah.
brand new car, come into the driveway. I get
So they
it.
can leverage their money. They can leverage and get in with a lot less.
Get in with a lot less. But like you said, buying a home in the middle of your transaction, going out and buying $10,000 worth of furniture and items to access the house are exciting.
Have you ever had a buyer do that?
Oh, this happens way more than often than you think. Because again, people think, oh, I'm pre-approved. Now let me get excited and I'm going to go buy the new car, the new van to haul the kids around, or pull it in the wonderful big garage. I'm going to have my new home.
Let me ask you this. So, one of the questions that I'm just thinking, let's say as a layman, how would a lender even know? So, you get pre qualified on the first, you're 3 weeks into escrow, you're closing the 15th of the following month. So, you got a 45-day escrow. You buy a car, your 20th day into escrow. Do you guys rerun the credit at the very end, or how does
We
the
don't
lender find that out?
that's a great question. We don't rerun the credit, but the person at the end of the transaction that's buying that loan, they have stipulations for us to say, please check again and rerun to see if there's new activity. And we'll get alerts even on our full credit report. And it'll alert us if they're having activity. And then we have to respond on that alert. And if that alert comes into a new, like I say, usually it's a car, and now they have a $600 more payment. That debt to income ratio went from this wonderful 43, and now we're at 52.
So you guys sign up on something and you get an alert, you're alerted. Oftentimes buyers will say, hey, I don't want to run the credit yet because I haven't chosen a house or I haven't chosen a lender. And I tell them, just by running your credit, you don't typically get a ding. People are under the impression their credit goes lower if it's ran.
That's a great question. If you run enough inquiries, and it would be a full credit report that would create that inquiry. What we do many times on all of our customers, we educate them and say, we're going to pre-qualify you on what's called a pre-qualification or a soft pull. It's all the same data, but it doesn't trigger any, it doesn't trigger their to reassess their score in risk, because it could be a risk. If I went out and pulled my credit 12 times, 15 times in a 30-day period, your credit agency is calculating their credit scores. They're going to look at that as a nervous item. Maybe they've been declined by 6, 8, 10 different people. And so they're going to say, wow, you're running all that credit. Or maybe they're aligning themselves to create a lot of new credit debt, which is now going to be a little bit of risk. So all these statistics have been run over. They're always crunching these statistics to find out what's the end result 2-3 months later. And
So it's called a soft pull. So you
a
can do what's called a
soft pull.
soft pull.
Soft pull, and it does not have any effect on their inquiries or any effect on their credit score. And so Obviously, when you're a loan officer or you're a bank, you think that you're the best institution. We have the best rates. We're the most honest. But we want to state, look, we'll give you the opportunity to shop, and we're going to give you, but we know that's an accurate number, and we have accuracy in pre-approving you, and we'll pre-approve them. We could even run what's called automated underwriting. I know those are words that you might hear here and there. And because some of the investors down the road will purchase a loan based on AI running statistical factors on, and they'd run it through an automated underwriting engine.
Well, you threw out the word. This is something that's on everyone's mind. I mean, I've been talking, especially during the holidays with family meetings and friends, et cetera. We were talking about AI. One buddy of mine who's a patent attorney, and he already was saying how much it's affecting his law firm because he said, yeah, we don't have to hire as many entry level legal teams, lawyers, frankly, but because AI does so much research. Have you seen any AI affecting your industry at this moment?
Oh, I think AI is moving forward. I do not think it's going to replace for some time. At some point, it might replace everything, right? I went to a drive-through restaurant and ordered through AI, and there was not a person answer. It was AI listening. But now AI is crunching data.
Well, yeah, right. So, I mean, it might, I don't think it's going to necessarily, it's going to replace a lot of industries, but I don't think it's going to replace, you're still going to need a Joe to contact. But I mean, will it replace maybe some of the underwriting? Well, I guess if you're not seeing much of it, you're not seeing much of it yet.
Oh, no, you hit it. No, you're correct. It has already started. We are aligned with some second trust deed lenders. You've heard of a term HELOC. Somebody says, I want to go get a home equity.
Explain what a HELOC is, everybody.
A home equity line of credit. My property is worth $1 million. I owe $600,000. I have equity, but I would like to tap into some of that equity, but I would like it in a credit line. So the credit line, you go to you can go to a bank. We go down to a credit union. Now we even have opportunities and we sell to these companies direct. The borrower then applies. They run a soft pull. Doesn't affect their credit, but the information's accurate. AI decides we like the credit right now. We would like to move forward. And so the borrower would link their personal bank statements. So the borrower links their bank accounts. AI then reads the bank statements. It looks at inflow and outflow, credits and debits.
This is happening right now.
This is happening right now. We sell loans right now doing this. And at that point now it says, okay, I've analyzed the credit.
When you say I analyze your credit or their credit is AI.
Yeah. AI, not I. Right. AI runs the credit. AI looks at the deposits inflow on these 2 months bank statements. If it still likes it, then it goes out to the internet and it scours a value for that property. So now instead it's not sending a person out there to appraise your property, it is going out to the internet and is finding closed loan data. Most of it's all public information. And now it analyzes and gives you a value on that home. So now it says, I've looked at your credit. I've looked at your debits and deposits. I've looked at the equity in the home. It makes a decision instantly.
On that value, I've heard about that because I've spoken to appraisers, and I know the appraisal business has just been diminished, meaning there's fewer and fewer appraisers. They are now going out to where these appraisals are, and I haven't been involved in one myself. It's always been an appraiser that calls me and we meet them at the property and we show them the comps, we show them the upgrades, etc. But we are moving towards that type of system to evaluate or appraise properties. And you're telling me that you're already seeing that as far as some of the loans that you're doing. In other words, there's not an appraiser involved. It's a computer generated value.
Yep. This whole process on this HELOC that I'm speaking about, it ran a soft pull credit. It analyzed the bank statements. All the borrower did is put in their login and password, which is all secure and encrypted. So, and they're safe there. Then it goes out to the internet and gives that property value. And now it makes a decision, says, here's the risk. And it immediately pops out a rate and here's some rate options.
And a value. And immediately it sends you a value of what they think the house is. See, this is interesting to me because we all see Zillow's value and Redfin's value, and I have a database that sends out values. And it's great. And people ask me all the time how accurate it is. And I often will say, well, first of all, look at Redfin and Zillow, for example. They always have different values. What does that mean? It means one of them's wrong for sure, but they're never actually ever spot on. In fact, frankly, even I get called out to homes all the time, and they ask me, "Hey, what's my house worth?" And I know that, and I don't blame them. They're hoping that I can tell them, "Oh, it's worth $1,237,000," but we only know ballparks. But so you're seeing on HELOCs, the AI are now they're basically AI is doing the appraisal for HELOCs. What about resale or not? Or yeah, what about purchase loans, purchase money?
These are primarily just HELOCs almost for equity refinances. So we were talking about AI and what its footprint is today. Where footprint comes in tomorrow is going to be greater and greater as all these institutions, most even buyers might have heard of Fannie Mae, Freddie Mac. Well, now they've compiled data and data and data and data. So for every one of the homes that they close, they have the data on that closed loan, that appraisal, and now those items are starting to be collected and measured against one another. And we're going to start seeing more and more valuations come because they right now even give it a risk score based on how much data they have. Many times on a purchase or on a refi, Fannie Mae has so many, or Freddie Mac, they have so much data in that area, they feel confident. And you've probably heard the term appraisal waiver. I got an appraisal waiver. And it's not just because the borrower was so great. They're saying, I have so much data on like homes. We are so confident we don't even want to spend the time or the money or the effort for you to go get that appraisal.
Let's jump back to Fannie Mae and Freddie Mac. A lot of our audience, they're not going to know what that is. Can you jump? I know it's a big topic and probably, and we got plenty of time. Explain to a fourth grader what Freddie Mac and Fannie Mae are.
Fannie Mae and Freddie Mac, we can't say they're actual government institutions. They're pseudo tied to government institutions. We fund the money to pool loans to create, we as in a nation, yes, the government, so people have opportunities to buy homes. Even on a greater sense, we're talking about FHA insured and VA insured. Those are actual.
You're opening up another can of worms, so we're going to have to explain those.
Yes,
too. This is good.
We're going to paint the picture of both. So those are government insured opportunities for lending. Well, Fannie Mae and Freddie Mac, they've actually are finding themselves a smaller and smaller imprint in the loans purchased. You're going to see the number of loans purchased by Fannie Mae and Freddie Mac probably reduce. You've already seen it reduce, meaning they have things called, big letters, LLPA, loan level price adjustments. So they've made all these price adjustments. I have a non-owner. They add 3% cost, not an interest rate. I have different LTVs, loan to values, and it'll give us a add-on.
Loan to value is if it's worth $1 million and the loan's 700,000, then it's a loan to value is
70%.
Okay, just so the audience would know.
Yeah, so they would say, okay, well, there is no hit or no price adjustment. But once you get to 80% loan to value, 90%, they're going to increase the loan level price adjustments. And so these things are now being filled in. Now we're going to even go into another term, but I'm not going to address it till a little later because I know you want to talk about non-QM. And people are going to you're going to see this name come out quite a bit. So Fannie and Freddie, they established, they have to be approved by an automated underwriting engine, and they have specific LLPAs based on them that determines the price for the borrower.
They're making money available for Americans to borrow in order to purchase homes. That's been pretty rampant in the last 10 years. Is that fair to say?
I would say that's fair to say, but I would say that the opportunity is decreasing. We've seen where primary home, I'm going to buy a home and I'm going to live in it. It had a certain price with almost very limited LLPA, loan level price adjustment hits. I'll just call them add-ons or hits. Second homes were the same price. Well, now in today's age, many, many people are buying second homes and they convert them to rental properties. The risk is much greater. So now they're applying the non-owner LLPA. We talked 3%. So now that second home gets that large 3% hit because in the past they used to perform like somebody that was buying and going to live in that home. those loans perform much better because, that's people's hearts. They live in it. They own it. They're proud of it.
Yeah, I know people have told me when they're selling them a rental property, let's say, and since we're on that topic, there's no reason we can't talk about it now, and we'll jump back to these. But on a rental property, when someone wants to buy an investment property, you're going to require normally at least 20% down. Is that fair to say? And the reason why is because if you think about it, if you're going to get foreclosed on and the owner can only make one payment, they're going to pay on their primary residence, not their rental property or their investment property, which of course we saw a lot back in the late 2009, 10, 11, when we had the market fluctuate. But is that true with still with investment properties? You guys being lenders, they require a much bigger down payment, at least 20%, or
at least 20%. Correct. So you have a 20% down payment, and again, they're going to get this large, LLPA.
LLPA is that what's
loan level price adjustment?
But basically cost.
A cost. Let's say they're going to have a much more cost. They're going to hit them with a 3-point cost. So if your loan amount is $500,000, it's an extra $1,500 you're going to get hit as a cost to purchase that loan, comparative if you were going to live in it. Now the market has really shifted in this area, and I know I mentioned the word non-QM. I know I'm going to be really excited about this topic. I know the word non-QM. All that means is it's a non-qualified mortgage. Typically that meets, if you go on, we're supposed to say ability to repay. They have certain sources on it, but what it means is it doesn't fit Fannie Mae and Freddie Mac.
Give us an example of something that wouldn't fit Fannie Mae or Freddie Mac. What's an example? Self-employed people?
Self-employed person comes in, you look at their tax returns, they make $1 million in gross receipts. They write off the world. They market their motorhome, their boat. They write off the lawn signs they have out there, and they pay taxes on $100,000. Well, now I only got approximately $9,000 a month in qualifying income, but I made $1 million, and so in the non-QM world, they've already done all this risk analysis, and they realize it's more based on what you're really generating. So they'll create a bank statement program saying, okay, we understand your tax returns didn't say it. We just want to see 12 months business bank statements. And we can qualify you for up to 80% of those deposits. So now I'm looking at $800,000 of annual qualifying income versus $100,000.
That's huge.
That's huge. And I might only be looking at a difference of 0.25% in interest rate. So that 0.25% in interest rate is nominal, but you're still getting primary financing with high loan to value, and that non-QM, it is taken over 40% of current residential lending right now. People would be amazed. I've had estimates of people that told me this 2 years ago that it was going to be 50% in the next few years. It's almost there when we're only doing about 10%. The same people that are educating me say shortly we're going to be 70%. But what that means is at the back end of these non-QM loans, there's massive companies, 5 of them, let's say, Goldman Sachs, JP Morgan. There's these huge Wall Street firms that most of these things end up at anyways. So they're analyzing the risk. And what is that risk to them, to what they'll pay you for? Their rules are less because they just are basing on what's the risk to their investment and what's the return on their investment. And so they're now actually pricing much better at times than a Fannie Mae loan for a non-owner occupied property. So right now, you are a top agent. I know.
So what you're saying is, so for non-owner occupied, I have to look at my notes, these non-QM loans are typically far better.
They're becoming almost dominant in the lending space. And I'll give you a couple examples. You've done a lot of loans. If you're showing somebody a rental property and they say, well, I need a gift for my down payment, you would say, oh, Fannie Mae doesn't allow gift on a non-owner.
A gift, everybody, is when you don't have the money saved, and then the bank will allow you. Typically, it's a relative, but it doesn't have to be.
Yeah.
A gift, and they require a letter too that says, "Hey, this is a gift, not a loan,
not
repayment."
Okay,
correct. Okay.
And I've had many transactions come down the line. Hey, I need the last few things I need is you to liquidate that stock account, send us verification of your down payment. Then we're going to close. We're going to be clear to close, and the agents are all going to be happy. We're going to close on time, and they come in and they send us a gift letter. And I've had this happen in the last few months. And I'm like, oh boy. And they're saying, we're not closing and because I'm not going to liquidate my cash account. I want to use a gift from my family. Well, for Fannie Mae, I'm dead in the water. I can't do that. I could do that for all owner occupied properties. But what's great, so now on the non-QM, I'll give you an example. If I was putting 25% down on a non-QM rate, I had this loan come to me. I help people solve a lot of problems at the bank, being the vice president, and been doing loans for 40 years, means I'm old, and I know a lot about loans. Our investor will allow, if 25% down and more, they'll allow 100% gift to come in for the down payment on a non-owned transaction. That opens up a lot of buying opportunity in the investment world. They're putting down 20%. The purchasing bar would only need to bring 5% of their own money. All the rest could come in from gift. That's
We're talking about
powerful.
buying a rental property, investment property.
Buying a rental investment property. That's powerful. That's creating all kinds of opportunity. Now we're in the non-QM world. You're talking about something, and you're going to hear these four letters a lot. You're going to hear it a lot more coming. DSCR, debt coverage service ratio. What does that mean? So again, we have these firms like Goldman and JP Morgan wanting to buy an investment. They're telling us if that property generates a monthly income that's equal to or greater than what the principal and interest and the tax and insurance are, we don't even want to verify or even know what the borrower does for a living for income, because they're doing this as a business loan. They're just saying this property cash flows. That borrower's not going to default.
Slam dunk.
Slam dunk. They put 20 or 25% down, kind of like you would do a commercial loan. The borrower doesn't matter as much as how does the rents look and compared to paying for that building. And this is a small investment, one property, one rental. Does it pay for itself? And at that point, no income's even listed. Don't even list your employment on the application. It funds. And again, you can even have 100% gift on this type. Again, because the person buying it, they just want to make sure it's going to pay. And
yeah, the buying the loan, the investor.
The investor and there's always an investor at the back end, whether it's, we talked about Fannie Mae, now we're talking about Wall Street, and that who ends up with a lot of the non-QM business.
On that note, we're doing this podcast in the middle of during these LA fires that are going on. I was talking to a good friend of mine who's pretty savvy, and he's been in the real estate industry for as long as I've been in the real estate industry. And I remember last time when North Orange County caught fire. And in fact, I was able to luckily get a rental for a friend of mine whose house did burn down. We're going to see probably rental properties prices, lease amounts go up dramatically with 10,000 displaced residents. He also hypothesized or predicted probably pretty accurately that there will probably be a lot of people moving even out of the area because of these fires. If I remember correctly, I'm sorry, I know this podcast isn't about the fire situation, but
it's real life.
I think there's 10,000 homes, if I last count, approximately. Who knows where it's going to end? Hopefully, no more. But what's my point? I guess my point is when you're talking about investors and rental, they put in the rental value. Those are potentially going to be even increasing, especially near those areas. Again, that's, I guess, a side note. We can go back to the podcast.
That's a great point. That's part of the podcast. Is yes, that's going to create more and more opportunity for people to purchase more and more non-owner homes. Again, the greatest creator of wealth in our American history has been home ownership, and the valuation of those things growing. If I can come in and not verify my income, my rent pays for it. I'm watching borrowers come in every 5 months. They're in sometimes family investment pools with gifts. They're putting these things down. The property's debt service. That means that rent covers their PITI. So now I have a cash flowing property, and now I'm going to go ahead and move down the line and get another one, and we're going to get another one and another one. And people are creating great wealth with these opportunities.
And actually, not back to the fires, because he mentioned something else about not only are people losing these homes, schools are burning down, stores are burning down. I mean, we're probably going to kind of around that fire area, that real estate's going to be probably hot, pardon the pun. I'm not trying to be funny, but it's going to be very strong because these people are obviously going to be displaced and are going to need to buy somewhere. So, okay, I'm sorry. Let's get back to the.
Stay tuned for part 2, where Darryl discusses with Joe about how to leverage your money using your credit, the maximum amount of a loan, and if rates are going to go lower. Only on the Jones Zone.